Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Sonia Shenoy and Pavitra Pari. Good morning, girls. Friday morning, finally, right? But for our markets, after opening around that 18,380 mark, we've lost ground. The Nifty slipped about 130 points from the day's high. We're down 0.5% on the benchmark indices. The mid-caps are underperforming. For the week so far, Nifty Sensex is down 0.5%, while the mid-cap index is down 1.7%. So there has been that element of underperformance. The advanced decline ratio is struggling, 1 in the green for nearly 2 in the red. And today, the Asian market picture is a bit mixed. So you've got markets like the Hang Seng and the Korean markets, which are currently in the green. So, that catch-up trade seems to continue to play out, at least for some of these Asian markets from very oversold levels. But our markets are struggling a bit at these levels. Hi.
Hi, morning, Pavitra. And I think it's a fear of heights, right? So there's this all-time high is sort of elusive for our markets, and I guess it'll perhaps take some time. That's also because investors globally are analyzing the prospects of perhaps higher interest rates coming through, and there's a lot of economic data as well. So give and take everything, this profit taking perhaps is expected today, given that it's Friday and you're heading into the end of the week. Global markets could head in different ways. Also, I want to point out in Asia what's happening is that inflation continues to dominate mind space. So Japan has seen its core inflation, which is the highest in the last 40 years. So this inflation growth challenge is something perhaps that would keep a lid on the market gains.
Oh, absolutely. So let's see how that moves. For today, like we pointed out, it is a slightly slow day once again that we are seeing. If you can just take a look for the week, what some of these indices have done. So the Nifty PSU Bank, for instance, is up 2.5%. While on the downside, you have something like a Nifty FMCG or the Auto Pack, which has seen some cuts. So still, even in this kind of weak or slow market, you still have the PSU banks which are doing well. A few of the bigger names will come up for you, and take a look at some of the smaller ones as well. So the likes of, these are the bigger ones, but if you take a look at something like a Bank of Maharashtra, IOB, Central Bank, these ones are seeing good gains amongst the banking pack. So that's what's happening as far as the market action goes. We are going to keep talking about this, about the market action. But as we do that, we'll also... All right, we are waiting by for our next guest. So let's do something. We'll take a look at some more of the stocks which are in focus. The auto stocks are up on your screen. These ones, like I told you, for the entire week, it's not done well. The index itself is down around 1.5%. These are some of the bigger names which are seeing cuts. A lot of the new listings have been under pressure. And a key cue, this is, by the way, in spite of the fact that we have crude prices which have trended so much lower. So our markets are seeing pressure in spite of that big benefit that has come through from the crude prices.
I think, this is a big tailwind, right? Brent prices, yeah. This is what, a 1-month low that we're sitting on in terms of Brent prices. And when the prices go up, we talk about it being a headwind. So when the prices are going down, we should talk about it being a tailwind as well. I think the 4-week low that Brent hit was 89.53. So this is, of course, because of there are some demand concerns. The demand outlook is something that's clouding the market as well. In China, infections have also gone up. So once again, COVID concerns giving rise to demand issues there is something that's bringing Brent crude down. So it works well for markets like our own. But let's do one thing. Let's discuss also what's happening in the commodity space in a bit with Manisha Gupta. Lots of corporates lined up. So let's get you the first corporate. Pratap Snacks. Let's talk about food now, our favorite topic. It's the second quarter earnings that Pratap Snacks has reported a revenue growth of 20% on a favorable base. However, the higher depreciation and lower other income weighed on the profitability. We have Amit Kumath, who is the Managing Director and Chief Executive Officer at Pratap Snacks, who joins us now. Amit, thanks a lot for joining us. Can you tell us a little bit about the demand situation now that things have opened up? Is it back to pre-COVID levels? And, you've had a fairly good run. You're sitting on a run rate of almost 500 crores per quarter. What could the growth be in the second half of the year?
Firstly, I think the demand is back. It is much better than the pre-COVID levels. They're almost run rating close to 500 crore rupees. And on the demand side, I think the demand was a little bit lesser for the month of October because of the Diwali season. But things have picked up very well right now.
So one would have assumed the Diwali season would have meant that the revenues get a boost, right, for a company like yours. Could you tell us why it works in the reverse way? And in the month of November, the first half, have things revived? And what is the quarterly run rate? As my colleague was asking, you're almost at 450 crores of a quarterly run rate. Can this inch up to 500 crores, say in Q3 and Q4?
I think we are close to better than 450 crores, and I think the run rate can go to 500 crores probably in next 2 to 3 quarters time. Diwali season, lot of retailers sell sweets basically, so the savory snacks impulse purchase sales goes down a little bit.
Okay, got that. Amit, thanks for joining us. This is Pavitra. I also want to get a sense in on what is happening with the margins, because those have still, been under some kind of pressure. With costs coming off now, what is the kind of margin that you expect going forward, say by the end of the year?
I think the costs have come down considerably.
Yeah.
There have been an improvement in the last quarter, and we see further improvement going further. We are aiming for a double-digit EBITDA margin next 2 to 3 quarters.
Okay, double-digit EBITDA margin for the next 2 to 3 quarters. Got that. Want to ask you a little bit about competition as well, because now there is a new listed player in the market. There's BKG, and this has become a highly competitive space. And your own growth rates have actually fallen compared to, say, what you would see about 3-4 years ago. How are you going to combat competition? Will you sacrifice on margins for higher growth or higher volumes? What are you looking at?
I think we have grown quite a bit in probably last 2 quarters. We have grown almost by 30% in the first half of the year. And we think we can grow easily by more than 15% going forward also. I don't see any reason for the competition hampering the growth side. On the margin side, it is more dependent on the commodity pricing, and they have definitely cooled off. With all the changes what we have done in the channel margin and the manufacturing process, I think we should be able to get to double-digit EBITDA margin with more than 15% growth.
To what extent have palm oil and packaging costs come down from peak levels for you as we stand currently?
I think palm oil has come down by more than 30%.
Okay.
And laminate prices by more than 15%.
Okay, that would mean your packaging costs?
Yeah, packaging costs. Yeah, definitely. The packaging costs have come by more than 15%.
So double-digit margins should sustain, right? After you hit it, say, in the next 2 quarters?
All
Definitely.
right, double-digit margins should sustain. The next question I want to ask you is on the capex. You had committed, under the PLI scheme. If you could just take us through when that really comes on stream, and also the revenue expected from this was around 26 to 2700 crores. So if you could just take us through the timeline.
So basically, we are putting up one facility in Jammu with an investment of more than 100 crore rupees. The PLI scheme, we have committed 105 crore investment, out of which almost 60% have already been done. And we feel that with the Jammu plant, we have additional capacity of 350 crores on the yearly basis. So we hope that this plant should go online by next Q2, by end of Q1 next year.
Okay. So will all of this capex be put on board through your internal accruals? Will you look to tap the market at any point? And will this put any pressure on your debt?
No. We have enough cash available with us. We don't see any debt to be taken.
Okay.
Okay. Sir, I know you're not worried about competition, but there is competition. Could you give us a sense about ad spends? You have said that you are looking to increase it by 1.5%. Just take us through the outlook on ad spends going ahead. And what is your current market share?
So normally there are 2 kinds of ad spend what we spend. We manufacture potato rings basically, which is with a toy. And we are the biggest player in that category. So we advertise on kids channel. That's a regular advertisement what we do. Now we are planning to do some promotional expenses, some brand building exercise probably in Q1 and probably Q4 of this year. And the ad spend should go by 1.5%.
And your market share?
The ad spend should go by 1 to 1.5%, up by 1.5%.
Got that. No, I wanted to understand, what is your current market share? Has it gone up? Has it come down? And what are the dynamics?
I think it's close to anywhere between 4 to 5%. And with the 15 to 20% growth, it should definitely go up.
Go up to?
The target is to take it to 10% probably next 5 years' time.
Okay, take it to 10%. Can you take us through where do you think a bunch of this growth will come off? Right now, of course, the snacks category is 58%. You have namkeen and sweets at 16%. And 3% respectively. Can you tell us where you expect a bunch of this growth to come from?
I think we are expecting major growth to come from Namkeen,
Okay.
which is currently very low, probably 12 to 13%, can go up to 25%. And second, if you see the market side, there are very strong markets where we are not good. If you see UP, Delhi, Punjab, we have recently gone into North India, and we hope that major growth should come from UP, Bihar, Punjab, and Delhi.
Okay, all right. Thanks a lot for joining us and speaking about the business and the way forward. Thanks, Amit, for being with us on the channel. That's Pratap Snacks for you. It's had a fairly decent run. Let's slip into a quick break. On the other side, we'll discuss what's buzzing in the commodity arena with Manisha Gupta. Stay tuned. Welcome back. It is turning out to be a bit of a sell-off for the market. So the Sensex is now down almost 400 points. And what's leading from the front, if you look at it on the downside, on the index, that is the Nifty, M&M is your biggest Nifty loser, down about 2%. You have Titan, Britannia. So a lot of the FMCG consumption names are under pressure right now. Tata Consumer Products are all down. iSure, there's a sell-off there. Bharti Airtel from Telecom is also seeing a bit of selling pressure. This week, though, Coal India is your biggest loser, followed by ITC, M&M and Titan. So consumption is definitely seeing some profit taking this week. Manisha Gupta joins in and to tell us a little bit about commodities. And today's shift, the focus is on crude. Manisha, over to you.
Sonia, thank you for that. So even with a 0.5% gain right now in the Asian markets, we are just about holding $90 for the crude oil prices. In the New York session yesterday, we did see a breach of that as well. So overnight, it has been 3% of a decline for crude. We are down by nearly 6 to 7% on the week. And this is after nearly 6% of decline in the previous week as well for the Brent and 3% of decline for the WTI crude oil prices. The pressure comes in as Chinese demand concerns are back in the markets. The COVID cases have continued to rise there to the tune of 23,000 now, which is the highest since the month of April. And that's a bit of a dampener for the demand there. Also, NATO has cleared Russia of the missile attack that happened in Poland. So the geopolitical premium also seems to be getting off. Also, the oil flows from Russia to Hungary via the Druzhba pipeline have restarted yet again after 2 days of shutdown. So the markets are looking at supplies coming back as well. And then the US manufacturing activity declined the most since 2011. So the markets are looking at weak economic data in the developed countries too, including Europe, where also we saw the investment and the retail sales numbers continue to decline. What the crude oil prices have done in 2022 until now is majorly a weaker side in this quarter as well. We did see a 14-year highs of around $139 per barrel for crude prices in the month of March. By September, we had seen the prices decline all the way to $82 a barrel. It was $100 a barrel in the month of October, but currently just about holding $90 a barrel right now. Markets do believe that much would depend upon how the U.S. non-farm payroll data comes, the December U.S. Fed meeting and an interest rate hike thereon. These are the two major factors before we understand on where the crude prices are closing on for this year.
Thank you very much, Manisha, for that. Get into a break. When we return, we'll get you excerpts from our conversation with Mphasis MD and CEO Nitin Rakesh on the company's outlook for growth, business expansion, and their M&A plans. Stay tuned. Welcome back. Let's straight away get to an important corporate conversation from the technology space. Now, yesterday I had a chat with Mphasis MD and CEO Nitin Rakesh, and we discussed a lot of things, right, about the long-term tailwinds for the tech sector, the near-term headwinds, what their M&A plans are, and how their business plans have also changed, keeping in step with the uncertain macro environment. But the first question that I began the discussion with are the near-term headwinds and which are the pockets that the company is seeing currently, which are the current pockets of stress for the company right now. Listen in to a slice of that conversation.
There are pockets of higher stress versus lower stress, things that are more linked to global trade, e-commerce, because they're normalizing, the big boom in tech that happened post-COVID. Those are a little bit, I would say, more susceptible to slow down. And of course, within financial services and banking, if you have a very strong capital market orientation, IPOs, issuances, bond issuances, M&A activity is down. So I think those are probably a little bit more, I would say, hit by the immediate impact. Mortgage is another one because, when you have such a sharp spike in interest rates in such a short period of time, it destroys a lot of demand for new loans and refinance loans. But at the same time, housing prices are pretty good. So, you have the tailwind on the home equity side. So it's a little bit of a mixed bag. I think airlines were really stressed early on in the pandemic. really on a big recovery tear right now. But in general, I would say there are segments within banking that are very strong as well. Payments, credit cards, consumer banking, wealth management, asset management, still doing fairly well. So I think if you have a broad portfolio across multiple sectors, even within the US, outside of the US, you will see these pockets of stress. But I think, as you mentioned, the structural tailwinds of digital transformation, cloud adoption, data engineering and modernization, data platforms, cybersecurity, and in general, anything that takes cost out of legacies is actually very, very welcome.
So let me
right
just
now.
pick on the points about the sectors which are under stress. E-commerce, tech is slowing down. In banking and financial services, the mortgage bit, as well as the part which is exposed to capital markets, right? These are the four that you outlined. What percentage of your portfolio would be exposed to this?
That's very, very difficult to
Broad range.
You know, it's 50% of our business is banking. Within that, a small percentage comes from mortgages, for example, right? So we're talking about a low to mid-single-digit exposure to that segment.
Okay.
Now, does it mean that it doesn't hurt? Of course it does, because in the end, if even a small part of a business doesn't grow or declines, that pulls the overall growth down. So I think, but from a focus perspective, 67% of our revenue is application-centric, which is fairly very healthy. Grew even in the current environment, it grew 35%. In the last quarter. So I think that's really what I meant about the tailwind from digital transformation driving that kind of growth.
Okay. But just coming back to the sectors which are headwinded, would you say about 5 to 10% of your portfolio, your client base, revenue base would be a little stressed?
Probably in that range.
5 to 10%. What about Q3? Are the furloughs going to be higher than what we've seen historically?
I think two things have happened this year. Firstly, the furlough started a little bit sooner. We had a couple of situations in Q2 as well where clients came back and said they ran into budget issues, business hasn't kept up, so they need to kind of reduce expenses. Some of that was obviously not baked into anybody's calculations. Second, on a YY basis, this time last year was a very different environment. Right? The impact of furlough was actually more muted because the mindset of people was, I want to hold on to this talent, so I want to minimize the impact of furlough to this talent pool, because if I put them on a long furlough, I may not actually get them back when it comes back to January. This year, the environment is a little bit different. So I think there will be, on a YY basis, you will see an expanded impact across the industry, not just for us this year. However, I think there are things we can do to minimize that impact, and we'll probably get a better idea in the next couple of weeks. But my sense is, on a YY basis, this will look a little bit harsher. But also because the impact started a little bit sooner, you may not actually have to see all that impact in quarter in Q3 as well.
So on the whole, it's more, but it's just spread between Q2 and Q3.
Some of it is spread, and on the whole, compared to last year, it'll
be a lot more. Okay. How are your business plans changing? You had plans to double down on healthcare, logistics, expand in Europe.
Yep.
So given the environment that we are in, the uncertain environment, how are you changing your business plans?
See, our business is a reflection of our clients' business. Yeah. If they are doing relentless prioritization of their spends, we have to do the same.
Correct.
As such, we haven't really pulled back on any of the growth initiatives. We are still a very growth-oriented, growth above all else mindset. We will continue to invest where we think there's great opportunity for wallet share gains or new expansion. And I think you talked about healthcare, absolutely the right place to be. Within logistics and transportation, we've continued to invest. We've actually expanded our travel portfolio, airlines included. Within banking itself, we have a whole set of customers that we never did business with, but they're large tier 1 BFS names in the US, so they are expanding Europe as well. We've also doubled down on making sure that within other segments that we already are present in, for example, insurance, we expand from the point of view of not just bringing in more new customers, but our portfolio of services that is very successful in banking should actually replicate in insurance. So we haven't taken our foot off the accelerator when it comes to investing for growth. However, given the situation in markets like Europe, we've basically taken a view that we will hunker down and say, let's focus on where we already have a presence versus a Horizon 2 or Horizon 3 market. So we are really focused on UK. We have expanded actually from London even into Scotland. We have actually a lot of assets on the ground. In Scotland, we've got a pretty good presence. In Leeds now, we opened a center there last year. We've got big presence in France, so we've doubled down on that as well. But we, in a way, deprioritize some of our initiatives going into the continent in a much bigger way.
Okay.
We have a center in Germany, but we are still right now in a mode to see how that situation stabilizes without having to stretch ourselves too thin. So I think it's a little bit of a reprioritization, but the focus still is very much growth oriented even in India, we're actually investing for growth because we believe there are some really marquee clients that are doing some cutting-edge work in India. There are US customers I wanted to learn from as well. So I think it's a all in all.
So slowing
growth.
down on continental Europe expansion while focusing on your existing markets like UK.
I wouldn't say slowing down. I would just say reprioritizing some of the
Reprioritize.
investments based on the geopolitics and the macro situation.
So you're doubling down on M&A?
We do. We just hired a new head for M&A, and he joined us a couple of weeks ago. And the charter is very simple. We've built a pretty good organic growth engine over the last 5 years. Healthy double-digit, mid to high, double teens growth. Last couple of years has been blowout, right? Last year we had a 36% growth in our direct business, mostly organic. So idea is, can we continue to find opportunities in the current environment to expand our growth beyond just organic, and maybe expand our footprint into a new vertical, expand our footprint into an existing vertical that we are investing in. Healthcare is a good example. Maybe expand new sub-verticals within our existing sub-verticals. For example, TMT, we do a lot of work, but can we actually add a new service line within TMT, product engineering, new services, maybe add a new geography, that comes along with that acquisition. So I think the thinking is to do bolt-ons for capability, but at the same time, look at, expanding our growth rate using M&A as well.
Is this a good way to boost growth because organic growth is slowing down?
I don't think it's a replacement for organic growth. It's actually a bolt-on to organic growth.
Okay.
So I don't think you can ever build a business plan where you say my organic growth is slow, so let me go buy something.
But FY24 organic growth will be slow.
I think compared to 22, 23 probably, but 24 is too early to call right now. I think I would say a little bit of an offensive play, which says in an environment where everything seems to be at a reasonable valuation, maybe we can go buy something that actually gives us more headroom for future growth.
So acquisitions today are at a reasonable valuation.
That's what we would hope for.
Okay.
At least public markets have corrected. Private markets haven't yet fully corrected, but they will.
Do you have a size in mind that you would like to get to?
It's hard to, it depends on what you find with the right intersection of capability and price and
size even
else.
for emphasis.
Yeah. So we've in the past done, last year was a 100 odd million acquisition we did for a design services company. I would say that we can actually do bigger than that. Not all of the cash anyways gets used in one shot. You have an ordinary schedule that comes into play as well. So I think depends on affordability, but at the same time, risk-wise, anything that is 10% of revenue is a good size to think about from the upper end. Okay. Anything below that's less than 1 or 2% of revenue doesn't really move the needle. So I would say 5 to 10% of revenue is a good number to think about when it comes to size of deals.
Okay, so acquisitions that they're looking at could add about 5 to 10% of their revenues. One of the strongest stocks that we've seen in the mid-cap IT space, of course, had its fair share of a sell-off as well in the last 1 year or so. But let's do one thing. Let's get back to the markets now. Almost a 100-point sell-off is what you're seeing on the index. Mitesh Thakkar of earningwaves.com is with us. Mitesh, what do you do now? There is profit taking. This 18,350 to 400 level has proven to be a bit of a resistance for the market. What do you do for the rest of the day? I think your audio is on mute, Mitesh.
Yeah, some problem. Sorry.
Go ahead.
So my understanding is that market has been kind of slightly tired with the run up, and the hourly and the half-hourly indicators are slightly on the negative side. Typically indicate not a trend reversal, but some kind of loss of momentum. So I think the consolidation, the choppiness could continue. We have identified two pivots in this possibility of consolidation. One is 18,250 to 40, which is where we are trading right now, and the other one is 18,100. In case we see an hourly close below 18,250 to 40, then I think we might actually go down to 18,100. But I don't see a bigger decline than that. So that would be a great entry point. Otherwise, we'll wait for some kind of reversal to happen from these levels and see if we can have the strength to get past 18,400. Till then, it's a market which is slightly contracting, which is slightly consolidating, and therefore you need to be patiently waiting out on the index, and that's the way we'll approach it.
And stocks, Mitesh?
Yeah. So I have a buy and a sell call. On the sell side is Ashok Leyland. Keep a stop at about 146 here, and look for a target of 140 on the downside. The stock which I like on the upside is Axis Bank. Disclaimer, we have that in a long-term portfolio, but otherwise I think once it starts getting past levels of 867 and the day's high is around 866, I think that's the breakout point. Above that, I think the stock can possibly regain momentum and head towards targets of 890. So buy above 867 with a stop at 855 for targets of 890.
All right, Mitesh, thanks a lot for that. By the way, those visuals on your screen are live, and this is from the Standing Rocket Complex in Sriharikota, where India's first privately developed launch vehicle, Vikram S, has just taken off for its maiden flight. The mission is named Prarambh, or the beginning, and marks the Indian private sector's first foray into the promising space launch market. So the Vikram S rocket is a single-stage suborbital launch vehicle which will carry 3 customer payloads and help test and validate technologies in the Vikram series space launch vehicles. So exciting visuals coming through from there.
Oh, exciting visuals, and a great moment for the private space, right? I mean, this is a 4-year-old startup that has made this vehicle, Skyroot Aerospace. So it's the hard work of a small startup, barely been 4 years in the system, and big day coming through for Vikram S, the rocket launch. So great visuals there.
New age for the Indian space sector, and I guess it will provide an impetus to a lot of the other private sector companies who are also working in these innovative technologies to understand the space and the life beyond space. Let's take a very short break. Up next, we'll discuss market fundamentals. Devang Mehta, the head of equity advisory at Centrum Wealth Management, joins us next.
The morning, they are also now down around 0.4%, so slightly better than the frontline index, but you are seeing pain creep into that basket as well. But let's talk about the markets and take this conversation forward. We have Devang Mehta, who's the head of equity advisory at Centrum Wealth Management, who joins us on the show now. Devang, good morning and thanks for joining us. This is Pavitra. We have been talking about this pain or this fatigue that we're seeing at higher levels. Do you expect for this to persist for some time? Because, for the longest time, we were talking about being inches away from all-time highs, and we're really not being able to get past those levels.
Good morning, Pavitra. Thanks for having me on the show. I think clearly what we are seeing at this point is Indian markets are probably a bit of silver lining, if I can put it that way, in the global dark clouds where there are fears of inflation, there are fears of interest rate hikes, there are also fears of recession or a larger slowdown. That's what the Indian markets are representing at this point, that whether we are oasis in the desert. And I think the clear outperformance that Indian market had shown in the last 4-5 months particularly, and with very strong domestic flows, 13,000 crore was the last SIP number that we saw for October, and as well as November, where we are again seeing after a dull October for FPIs, the flows have been very robust, around 20,000 crores and more have flowed into November. So my sense is that India clearly emerges as a destination where a lot of global investors, once the global volatility subsides, I think it would be again emerging as a destination to get invested. Very important part is that most of the people in the last 3-4 years have treated 18,000, 18,500 as a ceiling, right? It has to cross that, but levels are not going to be sacrosanct. My sense is that once we get out of this zone where there is a little bit of consolidation which is desired in the markets because of a huge run, my sense is that all-time highs are just in sight. It's just an illusion for markets. But otherwise, I think there are a lot of opportunities emerging out, not only out of the earnings season, but also from the Indian macros and micros. I think a lot of things would emerge out. And for somebody who is in the longer haul, has a lot of money to be made in the next 2-3 years.
Okay, a lot of money to be made in the next 2 to 3 years. That's our cue, right? Where do you make this money? If one had to park some funds now, Devang, in individual stocks, what would top your list?
I think, rather than stocks, let's first dissect the sectors. My sense is, Sonia, there are so many opportunities which are emerging in the new age space. And by new age, I don't mean the typical internet companies which got listed or the payment companies which got listed. We will not had our site over there. But most of the companies we are looking at are into the universe where a lot of capex is being done. You look at the credit growth. I talk about the 4 C's of the market: the credit growth, consumption, discretionary, as well as high ticket consumption, capex, as well as this all will lead to corporate profitability. So where would the money be parked? Where should the money get parked? My sense is a lot of themes have emerged out of engineering companies. There are a lot of themes which are emerging in energy efficiency, energy management, automation, IoT, robotics. All these industries are ancillaries to play the capex. All these ancillaries are again very clearly a proxy play to play the India, not only the consumption, but also capex, very strong will. And if credit growth happens at 18% credit growth, which is from 2004 to 8 days, we are seeing that type of credit growth. I think BFSI, you can't miss the banking as well as the NBFC universe, particularly the large cap banking as well as the large cap NBFC universe, the consumer NBFCs. I think this all are companies which will do well. Home improvement or building materials, typically in India, has always been a consumption theme, more or less. So my sense is also people are spending. Residential real estate sales have been very robust. As a theme, you can play home improvement, paints, adhesives, ceramics, even cement to a certain extent, which has shallow cyclicality, looks good for the next couple of years.
Some names about these new age engineering and capital goods companies, because a lot of people have bet on this sector per se, but it's flattered to deceive long term. Even the larger ones have not really delivered a lot of returns. So could you give us some more color on these new age engineering and capital goods companies? How do you select them and why will it be different this time?
Yeah, so great question, Rima. Again, so I'll just cite certain examples and why we pick this type of businesses. For sure, are these companies lower in terms of market cap, whether they are mid cap, small cap? The answer is yes, but they are market leaders in their own domain. So to throw some light on this type of companies, there are companies like Honeywell Automation, right, who is sort of a giant in automation globally. Also, the India business has started to see some color. Last 2-3 quarters particularly were tough because of shortage of chips and other supply side constraints. But the company feels in fact, is guiding towards a strong around 2x, 1.5, 2x growth of economic growth that India would deliver. So this is one type of company which one can look at. Typically, also in the universe of where we talk about companies in energy management or to play the EV theme. Also, there are companies like Hitachi Energy, again, just giving an example, a very good company which is into energy management, which has softwares to track the level of transformer oil. A lot of such businesses, allied businesses, this company is into. Interesting type of a pick for somebody who has a 3-5 year horizon, not even in a shorter term. There are also companies like Siemens. There are companies in the universe. Most of these companies would probably do very well once the capex cycle has already started. People are doing brownfield capex. People are doing greenfield capex. I think all these companies would tend to benefit when probably India INC expands and people are around capacity utilization at this point of time.
Okay, Devang, thanks for joining in and giving us some ideas, some sectors, and the way ahead for the market. So that's Devang Mehta saying that this is the start of perhaps a long-term uptrend in Indian equities and there's lots of money to be made. The ticker though is showing you a different picture. For now, the Sensex is down about 0.5%. We'll take a quick break. On the other side, Titagarh Wagons came out with the second quarter numbers. Umesh Chaudhary, the Managing Director and Chief Executive Officer of the company, will be joining us. Welcome back to Trading Hour on CNBC-TV18. As promised, we're going to get to a conversation with Titagarh Wagons. They came out with their second quarter numbers. It's the highest ever revenue for the quarter. However, the margins dipped despite a low base. To discuss the quarter gone by, we are joined by Umesh Chaudhary, the Managing Director and Chief Executive Officer. Umesh, great speaking with you after a while. Just wanted to understand, I mean, this was a very good quarter on the top line for you. You did 600 crores of revenues, which is, you know, a growth of over 77%, but of course on a lower base. What's the average run rate that you can see in the second half, and what are the demand trends looking like? How's the order book growing?
Yeah, hi, good morning. Always a pleasure to be with you. So, yeah, we're happy with the set of revenue numbers that we've been able to achieve. So, if you really look at the growth trajectory, and if you look at the 3-year kind of period, so 16, 17, 18, we did an average annual revenue of 300 odd crores. The next 3 years, we did an average annual revenue of 1,000 crores. And now we've been able to get to a quarterly revenue of about 600 crores, and we are still not at our peak because we've been able to, as I spoke in the investor call yesterday, we've been able to do just under 600 wagons a month, about 550 to 600 wagons a month. In the next couple of months or 3 months, we have to get to a run rate of 700 wagons a month. So that would really get to the optimum revenue level. But we are pretty much on track to get there. So I would say that the journey that we had started about 3-4 years ago to ramp up our overall size of operations, we are well on track to achieve that.
Umesh, morning, and thanks so much for joining in. Could you talk a bit about any future metro tenders which are in the offing? I know the Pune metro tender you're executing, it's on track. You could complete it by the end of this fiscal year, Q4 FY23, or if not, Q1 FY24. But any other big metro tenders and details and size?
Sure, there are several metro tenders. We have participated in a few. There are some on the pipeline the tenders have been announced, and there are certain projects which have been announced, so they will be coming up. Then there are some train tenders from the Indian Railways like Vande Bharat. So we are kind of participating and evaluating different options. Our target is to get to a capacity of about 200 to 250 metro car production a year, which I think we should be able to get to within the next 2 to 3 years' time. I believe that the tailwind in the metro space or the passenger train space is quite strong, and we are in a very good position to be able to kind of play in this field because we are the first aluminium coach manufacturer in the country. And apart from that, we are also now setting up the stainless steel coach manufacturing facility because of the Bangalore Metro and CRRC contract that we signed. So with this kind of versatility within us for stainless steel and aluminium, we believe we'll be able to cater to pretty much the entire segment of the market requirement.
Okay, that is on the metros. If you could also take us through the shipbuilding and defense, because that order book is quite small, it's just around 3%. What is the kind of growth that you expect here?
So we did announce that we have acquired a small shipyard on the south side of Howrah Bridge. You know, we were constrained because of the air draft and the water draft in our existing shipyard, and we were only able to take limited kind of vessel orders.
Okay.
With this new shipyard that we have acquired, we are going to complement both our shipyard capacities. We are developing this business as a future business. So we are not really going full hog on the investment in the new shipyard. We first want to stabilize. So we've been pretty much able to stabilize our freight wagon business. Now, the second step, we are trying to kind of balance out the capex to be able to stabilize the metro and the passenger train and the propulsion business. And over the next couple of years, then we will go full throttle on the shipbuilding and the bridges and the defense. So we call that business vertical as SBD, shipbuilding, bridges and defense. We do the modular steel bridges also in that vertical. So that's how we are kind of spanning out the three verticals and the growth plans for across the three verticals in the next years.
Okay, you said that there are 200 to 250 metro car production that you're looking at a year. That's your target. What would this mean in terms of a quarterly revenue for you? You're sitting at 600 crores now. How much? I mean, could it be much better than that? What's the run rate?
Sure. So if you look at the current revenue, majority of it is coming from the freight wagons. So a metro car on an average costs about 9 to 10 crores. So when we are able to achieve the peak revenue on the metro segment, 200 cars would give us a 2,000 crore revenue only on the metro segment, which today is at a much lower base. So if you really look at the margins also that we are getting in the transit and propulsion because of the under absorption of the fixed cost, on account of not optimizing the revenue numbers, we are not being able to get the real potential of the EBITDA margins on the metro segment. So if we really look at the graph, the freight wagon segment is close to its optimum. The passenger train business, the metro and the propulsion business is just kind of taking off. And I believe in the next couple of years, it should get to the optimum level. And then we will kind of get the SBD on the runway as well.
What will this mean in terms of margins? Because as you get to optimum production, it will aid operating leverage. Your current margins are 8.8%, the way we calculated in the current quarter. Could these margins improve? What's the range that you're looking at?
The current quarter EBITDA margins are slightly higher. They are at about 10-11% on a blended basis. But if you include the other income, because as I can see from the screen, you've taken the revenue without the other income. But be that as it may, on a blended basis, the guidance that we have always given is that we should be at about 8 to 10%. Our business is one that gives us about 8 to 10% of EBITDA margins. And that would be the guidance that I would like to give to the market, to the investors, because that we believe is a sustainable margins. Having said that, on quarter-to-quarter basis, the margins can vary. Most of our contracts are with price variation clauses, so the kind of movement in wholesale price index gets affected in our revenue number, but on the next quarter, but it kind of the cost comes into the current quarter. So on a quarter by quarter basis, the margin percentages can change, but on a blended basis over a period of time, 8 to 10% is a reasonable EBITDA margin that we should target.
All right, got that. 8 to 10% is what you can see in terms of sustainable margins. Umesh, thanks a lot for joining us. We're going to leave it on that note today. With that, it's time for a short break on the show. But when we come back, there's lots more market action, so stay tuned.
Frankly, Vikram Vedha was extremely it was disappointing at the box office in the sense that, yeah, I mean, it opened and it ran and everyone who saw it really liked it. The reason I think there's so much, the reason we should be very polite to each other is because nobody has any clue what works or what doesn't work or what's going to happen. And that was pretty much dead cert, as we say, that this film with these two guys in it is going to open big, and since it's so well made, it's going to run. But it was disappointing. People will continue to make movies and we will continue to try. Prices will keep fluctuating because our pricing, some of it's insane. We pay people astronomically and the returns have been not good.
Welcome back. Nykaa has surged to the high point of the day. It's up 4%. In the morning, there was a large block deal where TPG, we understand, sold about 5.4 crore shares worth nearly 1,000 crore rupees. A couple of reasons why the stock could be higher in trade. One, the deal was done at 185 rupees roughly. So that's a minimal discount, just 0.5% discount to where the stock closed yesterday. Secondly, this is TPG's second transaction. They had sold 1.1 crore shares on 11th of November, and it's understood that perhaps this is a clean out trade from TPG. There are no more shares that TPG has, which will come into the market because whatever they had, they have sold. And third, yesterday, you also had Canadian Pension Plan Investment Board, which bought about 1.7 crore shares at a price of 175. So there are a lot of marquee investors who are interested in acquiring Nykaa. So that's about Nykaa, which is currently up close to about 4%. Other than that, for the markets, it continues to struggle. We're down 0.5% on the benchmark indices. We're going to take your leave on Trading Hour. Thank you for watching. Stay tuned. Halftime Report is up next.